positive sentiment and increased liquidity from central banks that had been driving asset classes since the start of the year waned in April. Many of the asset classes that had been outperforming gave back some of these gains, particularly European and Japanese equities, Spanish government bonds and commodities. Concerns about the risks associated with the Eurozone sovereign crisis re-emerged in April, while the fragility of the recoveries of some of the global economies also became more evident. On the other hand, the flight towards perceived safer assets classes such as AAA government bonds continued. The German government bond yield in fact hit another record low level since the start of May. The Eurozone sovereign crisis is the main factor which has been driving the increase in negativity. The liquidity impact from the cheap money that the ECB lent to the banking system in December and February has waned, and investors are now focusing on the fiscal, economic and political risks across Europe. The slippage in Spain's fiscal position during 2011, which had been ignored by markets during the first quarter of 2012, came back into focus in April. This overshadowed any progress that had been made on renegotiating the fiscal targets, the reforms to the labour market, or views that the domestic banks' uptake of the 3-year LTROs would support the banking system. These uncertainties about Spain have resulted in a downgrading of Spain's credit rating by Fitch and government bond yields increasing to levels that are uncompetitive for Spain to borrow. Elsewhere, the presidential election in France, as well as the collapse of the Dutch government, is highlighting a shift in politics in Europe, as these countries are considering that the current austerity policy may not be working. Any renegotiation of these policies will result in a lot of volatility for Eurozone government bond markets as well as for equity markets. Finally, the Greek situation has also returned to the headlines, as it appears the country is becoming much more closer to a decision on whether or not to remain in the euro. The environment for financial markets feels similar to 2011. The risks from the European sovereign crisis will lead to continued volatility for equity and bond markets. However, the continued recovery in the US economy, the more upbeat earnings news and reasonable valuations will provide some support, but in a very volatile environment for markets.